At some point, most American families will face a conversation they have been putting off. A parent needs nursing home care, or memory care, or assisted living. The family sits down and starts running numbers, the cost of care, what savings are available, what insurance covers, and somewhere in that conversation, someone mentions Medicaid. And then someone else says what most families assume to be true. You have to spend down everything first. You have to get poor before the government helps you. Everything you have worked for your entire life has to be gone before Medicaid will step in. That assumption is one of the most widespread and most financially damaging misconceptions in all of American retirement planning. The truth is more complicated. And for families who understand how Medicaid's asset rules actually work, specifically which accounts Medicaid counts and which accounts it cannot touch, the difference between the assumption and the reality can be measured in hundreds of thousands of dollars that stay in the family instead of disappearing into nursing home bills. Here is what almost nobody tells you before the crisis arrives. Medicaid's asset test does not count everything you own. It counts specific categories of assets, what the rules call countable assets, and excludes others. The excluded categories are called exempt assets or non-countable assets. And three specific account types that many families are not using, or not using correctly, fall outside Medicaid's reach entirely under current 2026 rules. Not through loopholes. Not through schemes that Medicaid can claw back. Through the formal exemption categories that are written directly into Medicaid eligibility law and that the federal government has recognized for decades. Understanding them before you or a loved one needs long-term care is the difference between having a plan and having a crisis. To understand why these accounts matter so profoundly, you first need to understand the scale of what Medicaid's asset test is designed to catch, and how little room it gives most seniors to work with. According to the Medicaid Planning Assistance Organization's verified 2026 eligibility data, in most states a single elderly applicant seeking Medicaid coverage for nursing home care is limited to $2,000 in countable assets. $2,000. That is the threshold below which Medicaid says a senior is sufficiently impoverished to qualify for coverage. For married couples where both spouses are applying, the combined countable asset limit in most states is $3,000 to $4,000. For couples where only one spouse needs nursing home care, which is far more common, the rules are more protective. The non-applicant spouse, known as the community spouse, is permitted to retain what is called the Community Spouse Resource Allowance. In 2026, that allowance is up to $162,660 in most states. The cost of nursing home care in the United States averages approximately $9,733 per month for a semi-private room and $10,025 for a private room according to current Genworth cost of care data. For a senior who lives in a nursing home for 3 years, a common time frame, the total cost runs to approximately $360,000. For 5 years, it exceeds $600,000. Medicare does not cover long-term nursing home stays beyond a limited rehabilitation period. Most seniors are not aware of this until the situation arrives. Private long-term care insurance covers it, but most Americans over 65 do not have a policy in force. Which means for the majority of American families, Medicaid is the only program that covers extended nursing home care, and qualifying for it requires navigating an asset test that would strip most middle-class seniors of everything they have accumulated if they do not plan ahead. This is why the exempt asset categories matter so much. These are the accounts that Medicaid has formally decided not to count. The legal categories of wealth that can be preserved through correct planning even while qualifying for coverage. The first account category that is invisible to Medicaid involves the primary residence, but with critical conditions that most families do not fully understand and that, when mishandled, turn an exempt asset into a countable one. Under 2026 Medicaid rules, your primary home is generally exempt from Medicaid's asset limit under several conditions. The home is automatically exempt as long as the applicant's spouse, a child under 21 years old, or a blind or permanently disabled child of any age continues to live in it. The home is also exempt for the applicant themselves if they are living in it, or if they have moved to a nursing home, if they have provided a written statement of intent to return. According to verified 2026 Medicaid eligibility guidance, the home equity interest limit for nursing home Medicaid applicants who are not living in the home but have expressed intent to return is generally either $752,000 or $1,130,000 depending on the state. As long as the home equity stays below the applicable limit, the home remains exempt. But here is where families make a costly mistake. The home exemption during the Medicaid recipient's lifetime does not protect it after they pass away. Medicaid's estate recovery program, known as MERP, requires states to seek reimbursement from the estates of deceased Medicaid recipients for the cost of nursing home care provided. The primary mechanism for that recovery is the home. After the recipient dies, the state files a claim against the estate, which typically means against the value of the home, to recover what Medicaid spent on their care. This is why the home alone is not a complete planning strategy. It protects the asset while the recipient is alive and while a qualifying spouse or dependent lives in it. But without additional planning to remove the home from the estate, through a Medicaid asset protection trust or other legally sound mechanism, the state may claim it after death. The second account category that Medicaid cannot touch involves a specific type of financial account that most seniors have never set up, and that functions as one of the most powerful asset protection tools available in the Medicaid planning space. It is called a Medicaid Asset Protection Trust, also known as an Irrevocable Medicaid Trust or simply a MAPT. Here is the core principle. Assets held inside an irrevocable trust, meaning a trust that you cannot unilaterally take back or modify, are generally not counted as your personal assets for Medicaid purposes. Once you transfer assets into a properly structured irrevocable trust, you give up ownership of those assets. They are held by the trust, managed by a trustee you designate, and ultimately distributed to the beneficiaries you name, typically your children or other heirs. But because you no longer own them, Medicaid does not count them against your asset limit. The critical element, and the reason this requires careful planning rather than a last-minute decision, is the 5-year look-back period. Medicaid reviews all asset transfers made within the 60 months immediately preceding a nursing home Medicaid application. Any transfers made during that 5-year window, including transfers into an irrevocable trust, can be treated as disqualifying transfers that result in a penalty period of Medicaid ineligibility. According to the Medicaid Planning Assistance Organization's 2026 eligibility guidance, violating the look-back period results in a penalty period of Medicaid ineligibility calculated based on the value of the transferred assets divided by the average monthly private pay nursing home rate in the state. In California, the average private pay nursing home rate in 2026 is approximately $14,440 per month. A disqualifying transfer of $144,400 in California would create a penalty period of 10 months during which Medicaid will not cover nursing home costs, meaning the family bears the cost out of pocket, defeating the purpose of the planning. The protection this creates is straightforward. Assets transferred into a properly structured MAPT more than 5 years before a Medicaid application are fully exempt from the asset count. They do not appear on the Medicaid eligibility calculation. They cannot be recovered through Medicaid estate recovery, and they pass to heirs through the trust without going through the probate process that would otherwise expose them to estate claims. The most important planning implication is one of timing. The 5-year clock needs to start before the need for care arrives. Most families who lose assets to nursing home costs are not the ones who had no options. They are the ones who waited until the crisis to explore the options that existed. A senior who establishes a MAPT at 70, when they are healthy and the need for nursing home care is not on the immediate horizon, has created a protected structure that becomes fully Medicaid exempt at 75. A senior who waits until they are already in a nursing home has no time to establish the 5-year look-back and no ability to protect those assets through this mechanism. The third account category involves something that surprises most people when they first hear it, because it is one of the most commonly held financial accounts among American retirees, and most people assume it is fully countable. It is the IRA and 401k, and whether it is countable or exempt under Medicaid depends on one factor that most seniors and their families have never been told to check. Medicaid's treatment of retirement accounts varies by state, but in a significant number of states, including Georgia, Pennsylvania, and others, an IRA or 401k is exempt from Medicaid's asset count if it is in what the rules call payout status. That means the account owner is actively taking required minimum distributions from the account. In Georgia, according to 2026 Medicaid eligibility guidance, IRAs and 401k of applicants are exempt if they are in payout status, meaning the required minimum distribution is being withdrawn. In Pennsylvania, the IRA and 401k of a non-applicant spouse is exempt entirely. What this means for planning is specific and actionable. An IRA sitting untouched, not yet distributing, may be a countable asset in states that apply this rule. The same IRA that has begun making required minimum distributions may be exempt under those exact same rules. For a senior or their spouse who has not yet reached the age at which RMDs are required, currently age 73 under the Secure 2.0 Act, beginning voluntary distributions earlier than required could shift a countable retirement account into an exempt category under the rules of their state. The distribution itself becomes income, which is handled separately under Medicaid's income rules, but the underlying account balance is removed from the countable asset calculation. The non-applicant spouse's retirement account protection is even broader in many states. According to Pennsylvania's 2026 Medicaid eligibility guidance, the IRA or 401k of the non-applicant spouse is exempt. Full stop, regardless of payout status. In states with this protection, a community spouse's retirement account balance does not count against the applicant spouse's Medicaid eligibility at all. The variation by state is significant, and the rules change annually. The specific treatment of retirement accounts in your state requires verification with a certified Medicaid planner or elder law attorney who is current on your state's rules for the current year. But the principle that retirement accounts are not automatically countable and that their treatment often depends on factors you can directly control is consistent and important. There is also a development in 2026 that every family with a parent approaching potential nursing home care needs to understand, because it changes the planning landscape in ways that affect the timing of any Medicaid preparation strategy. The One Big Beautiful Bill Act, signed into law in 2025, included approximately $1 trillion in Medicaid cuts to be implemented over a 10-year period. According to Medicaid Planning Assistance's January 2026 analysis, the initial cuts that took effect January 1, 2026 eliminated a temporary financial incentive for states that had expanded Medicaid eligibility to adults under 65 under the Affordable Care Act. Critically, and this is the point most news coverage has missed, nursing home Medicaid, which is the program that covers elderly long-term care, is largely protected from the funding cuts in the current legislation. The cuts are primarily targeted at expansion Medicaid for working-age adults. However, the same analysis flags that home and community-based services, the Medicaid programs that allow seniors to receive care at home rather than in a nursing home, are likely to be targeted in future funding reductions. This is significant. Home-based Medicaid waiver programs are consistently less expensive than nursing home care, and they are the preferred option for the majority of seniors who need long-term care. If HCBS funding is reduced or restricted in coming years, more seniors may be funneled toward nursing home placement, increasing demand on a nursing home Medicaid system that is already strained. This legislative uncertainty creates an additional planning argument for acting sooner rather than later. Medicaid rules that exist today, the exempt asset categories, the look-back period parameters, the CSRA amounts, are the rules currently on the books. Future legislative changes may tighten exemptions, reduce protected amounts, or modify the treatment of specific account types. Planning within the framework that currently exists, rather than waiting for clarity that may never fully arrive, is the approach that most elder law attorneys and Medicaid planning professionals consistently recommend. Here is the practical picture for any senior or family member who takes this information seriously. The Medicaid Asset Test, with its $2,000 limit for individual applicants in most states, looks like a system designed to strip every dollar from seniors who need nursing home care. And for families who have no plan, no protected accounts, and no time to establish a 5-year look-back, that is effectively what it does. But for families who understand what is countable and what is not, who have a home with a plan attached to it, who have considered an irrevocable trust while there is still time for the look-back to pass, who understand how their state treats retirement accounts and whether payout status changes the calculation, the outcome is entirely different. 3 account structures. 3 categories of wealth that Medicaid cannot see when the asset test is applied. The primary residence with proper estate recovery planning around it. The Irrevocable Medicaid Asset Protection Trust established with sufficient lead time. And retirement accounts structured to qualify for payout status exemptions in states where those rules apply. None of this is without complexity. None of it is a DIY project. The 5-year look-back means that the time to act is not when a parent is already in a nursing home. It is now, while the window is open and while the planning tools are available to use. The families who come through a long-term care crisis with their assets intact are not the ones who had more money. They are the ones who knew, years in advance, which accounts Medicaid could see and which ones it could not. This video is for educational and informational purposes only and does not constitute financial, legal, or Medicaid planning advice of any kind. Medicaid eligibility rules, asset limits, exempt asset categories, and look-back periods vary by state and change annually. All data cited is sourced from Medicaid Planning Assistance, MedicaidPlanningAssistance.org, Eldercare Resource Planning, and official state Medicaid agency publications current as of 2026. Always consult a certified Medicaid planner or licensed elder law attorney before making any decisions about asset protection or Medicaid planning.